Hi folks, welcome to this recording on share retirement. Again, you might find it useful to have the question by you so that you can refer back to the data as we do the entries. Now, in this first part, you'll notice in the question that they give you the opening balance of the corporation's 2000 X5 Shareholders Equity section, and you'll notice they have preferred and common shares, some contributed capital on the retirement of common shares, and they also have, in addition to retained earnings, an account called reserves for foreign exchange gains on foreign subsidiaries. You might recognize the term reserves as being one that's used under IFRS, which relates to or is the same as accumulated other comprehensive income, or AOCI. So you'll have to be watching for transactions or little items that they might give you in the question that might change the balance in the reserves or the AOCI. So let's continue. In the first transaction on January the 15th, you'll notice here that the company bought 7,000 preferred shares for $5.20. So that means they bought back some of their own preferred shares. So how much did they pay for that? Well, it says they paid $5.20 to buy back those 7,000 shares. So they used up cash of $36,400. But they have to remove the preferred shares from their books. And they would do that based on the average issue price, the price on average at which they issued them to shareholders. So we would have to calculate that average issue price. So how do we get it? Well, the first thing we do is we look at what's the preferred share equity to open the period. That was $386,000. So shareholders gave us $386,000 to buy in total 80,000 shares. So that provides us with an average issue price on the preferred shares of $4.82.5. So that's the amount on average that the investors gave us when they bought those 80,000 shares. So in order for us to remove the 7,000 preferred shares from the account, we remove them at the average issue price of $4.82.5. So that gives us a debit of $33,775. So you'll notice because it cost us more, $5.20, to buy the shares back, than the investors, gave us on average at $4.82.5 a share, we're going to have to shore it up on the debit side. In this case, you'll notice we debit retained earnings. If we had had any contributed capital on the preferred shares, we would have debited that first, but we don't have any in the equity section. We only have contributed capital on common share retirement, which we can't use because we're retiring preferred shares. So we need to debit retained earnings. You'll also notice here in the next transaction on February the 12th that we're buying back some common shares. It's costing us $11 a share to buy back those 2,000 common shares. So it's going to cost us $22,000 in total, but we're removing the common shares from our books at $8.02.5 a share. How did we get that? Well, we can see from the equity to open the period that we had shares of 80,000 shares, common share equity, and the common shares, the total common share equity to open X5 was $642,000. So that means that shareholders gave us $642,000, and in return we gave them 80,000 common shares. So that means that the shareholders gave us on average $8.02.5 to buy the shares that they bought, the 80,000 common shares. So we would remove those 2,000 of those 642 of those 80,000 common shares at the average issue price. That's the average amount that investors gave us, and that's $8.02.5. So that turns out to be a debit to the common share account of $16,050. So again, because we paid more at $11 a share to buy them back than the investors on average gave us when they bought them from us, that means we have like a little loss, but we don't call it a loss because loss goes on the income statement. What we need to do is we need to debit it to not a loss account on the income statement, but an account on the shareholders' equity side. So we would debit, in this case, contributed capital on common share retirement. Notice that we can debit a contributed capital account because if you check the opening balances in the equity section, we already have a contributed capital for common share retirement. That account right now has a balance of $14,000. So we only need $59.50 to shore up the entry, so we can debit that. If we needed more than $59.50 to debit the entry, and it was a number greater than 14,000, then we could debit common share, the contributed capital on common share retirement for 14,000, and then debit whatever balance we needed to retained earnings. But we don't have that situation. We have more than enough in contributed capital on common share retirement. And again, because we are debiting or we're retiring common shares, we would use up any contributed capital in the common share retirement account first before we need to go to retained earnings. And in this case, we didn't go to retained earnings to do it because we had more than enough to debit the contributed capital on the common share retirement. We had 14,000 in it, but we only needed to use up 59.50 of it. So we're good there. Okay, so now if we look at the next transaction, which was on February the 25th, we can see here that we are retiring preferred shares, 4,000 of them, and it's costing us $4 to buy them back from investors. Well, investors on average, we said before, gave us $4.82.5 on average. So now it's costing us less to retire them than what the investors on average gave us. So now we are creating contributed capital on the preferred share retirement. So in this particular case, because we're a little bit light on the credit side, we need to now debit the contributed capital on the preferred share retirement for $3,300. That's to balance the entry. So again, when we buy back the shares, we're buying them back at $4 a share. Okay, so it's costing us $16,000 to buy them back. But on average, investors gave us, for those 4,000 shares, $19,300. So we actually, because it's costing us less to retire them than what the investors gave us on average when they bought them, that gives us a $3,300 credit or additional contributed capital. All right. Now, if you look at the April 26th transaction, you'll notice here that we're retiring 5,000 more preferred shares, and we would take them off our books at the average issue price, which hasn't changed. It's still $4.82.5. So we would debit the account for $24,125. We would credit our cash for what it's costing us to buy them back and retire them. What it's costing us to buy them back from the investors is $6 a share. So what does that mean? It means it's costing us more to buy them back than what the investors on average gave us. So it costs us $30,000 to buy them back, whereas investors on average gave us $24,125. So we're a little light on the debit side. So what do we debit first? Well, we don't have enough in our contributed capital account on preferred share retirement. Or we have enough in our contributed capital on the preferred share retirement, right? If you check that out, you'll notice that in the previous question, we created $3,300. So now we can use up all or any of it that we need. To balance this entry, we need to use it all. Don't forget, we have to draw down on contributed capital accounts that are related to the share class we're retiring first before we can touch retained earnings. So because we have some contributed capital on the preferred share retirement that was created February 25th, and we're retiring preferred shares on April 26th, we can use that up. So we use that up first. We still don't balance, so the only other place we can go is to retained earnings, the only other equity account we can use up. So we debit that for $25.75, and that balances our entry. In our last transaction here, or our next transaction here, I should say, we now on July the 16th are not retiring preferred shares, we're retiring common shares. And we said earlier, if we go back, we know the average issue price of our common shares is $8.02.5. That's the amount on average that investors gave us for each share when they bought them. So now what does that mean? That means that we would remove the common shares from our books at the average issue price, the average price at which we issued the shares to investors initially, which is $8.02, times the 8,000 shares that we're retiring, removing from our books. So we're going to debit the common share account for $64,200. Now, it cost us less at $7.50 a share to buy them back from investors than investors on average gave us. So we're crediting cash for an amount of $60,000, which is less than the amount that investors on average gave us for each of the 8,000 shares, which would give us a debit to common shares of $64,200. So that means we have like a gain, but we can't call it a gain. Why? Because gains go into income. We haven't got an income transaction here. We've got an equity transaction, which means that we can only credit a contributed capital account. Common share retirement, because it relates to common shares being retired, so we can credit a common share retirement account for contributed capital, and to balance, that's going to give us $4,200 in that account. Now, on July the 30th, what happens? It says here that the company declared a 5% common share dividend. So they also told us that on the date that they declared the dividend, the shares were trading at $7.75 a share. So now we have to prepare a journal entry that records the declaration of the share or stock dividend and credits common shares because the dividend was declared and issued the same date. Notice this isn't a cash dividend, it's a share dividend. So we do not debit cash, or credit cash, we credit common shares. Why? Because we're issuing common shares, we're not giving them cash. So the first thing we need to do is we need to figure out how many common shares do we have up to July 30th, which we're taking 5% of it, because we're going to issue 5% of the total shares we have as an additional share dividend. So the question becomes, how many additional shares are we issuing at $7.75 a share? Well, we can see here from the calculation I've done below, we have 70,000 common shares as of July 16th. How do we know? Because the question told us that at the beginning of X5, we had a total of 80,000 common shares. You remember that we bought back common shares of how many? 2,000. When did we do that? We did that way back on February the 12th. We bought back 2,000 shares and retired them. So we took 2,000 shares off of our books, right? And then we also retired an additional 8,000 common shares here on July the 16th. So that means we have 70,000 common shares as at the date of July 30th. We'll take 5% of that. So that means we are going to issue an additional 3,500 shares at the market price at the declaration date, which is $7.75. So we're going to debit our share or stock dividend declared, and we're going, or you could do it directly to retained earnings for $27,125, right? Because this is $27,125 if you do the math. And we're going to credit common shares for $27,125. Now, on November the 30th, they said the board of directors declared a dividend adequate to pay $1 per share to all common shareholders. This meant that they also had to declare the preferred dividend. So what do we have to do there? Well, the first thing we need to do is we need to make sure that we know how to calculate the number of preferred shares outstanding, because the question tells us that the preferred shareholders are also going to get a dividend. So the first thing we want to do is find out how many preferred shares are outstanding that will pay out a dividend, that we'll have to pay a dividend on. So I've calculated here 64,000. How did I get that? Well, you remember on January the 1st, X5, we had 80,000 preferred shares that were issued and outstanding. That's in the little equity section that we gave you. You'll notice that after that, after January 1st, X5, you'll remember that way back on January 15th, we retired, we canceled and retired, we bought back and retired 7,000 of those shares. You'll also notice if you go back down to February 25th, we also retired 4,000 additional preferred shares, and again on April 26th, another 5,000. So therefore, if we go down here, the 7,000 that we retired on January 15th, as well as the 4,000 we retired on February the 25th, and in addition the 5,000 we retired on April 26th, leaves us with 64,000 preferred shares. Those preferred shares are going to pay out a dividend, according to our data in the equity section to open January 1st X5, 70 cents a share. So we are going to have to declare a dividend on the preferred shares of 44,800. That would be 64,000 times 70 cents a share. And because we're not paying the cash dividend yet, we would also credit our preferred share dividend payable. So maybe if I do this in color, it might help. Ooh, maybe that's a little bit too light. Okay, we're going to credit the preferred dividends payable for 44.8 and credit the preferred dividends declared, or you could do it directly to retained earnings if you wish, for 44.8. But don't forget, we already calculated up here that we had 70,000 common shares on July the 30th, and on July the 30th we issued an additional 3,500 to satisfy the share dividend requirement. So now we have 73,500 common shares, each of which are going to get a $1 per share dividend. So if we go here now, we can see that we would credit our dividend payable. Again, it's a payable because we've declared but not yet paid it according to our question, and we're going to debit common share dividends declared of 73.5. All right, so you could, as we've shown up here in the bracket, you could debit directly to retained earnings, but as we've always said, whenever you're declaring to pay at a later date, two different dividends on two different types of shares, you should separate out the liability accounts. In this case, one for the preferred share dividends and one for the common share dividends. Now, in requirement 2, they've asked us to do the shareholders equity section. Some of you might have been smart enough to be running a T account. That's fine. If you didn't, we can just do the math right here in the equity section so you know how we got all the numbers here. We've already calculated in the equity section for the preferred shares that we have 64,000 shares outstanding. We already know common shares, we have 73,500 outstanding. What we need to do is get a handle on what these numbers are, how we got those. Well, we know if we check the data in the preferred share equity section that opened up X5, they told you that you started the period with 386,000 in preferred share equity. We know that during the period, what did we do? On January the 15th, so I tried to footnote everything here for you. On January the 15th, we debited the preferred shares account for 33,775. That's when we bought back our 7,000 preferred shares. If you want to go back up to the top and just convince yourself that's true, I'm looking at this transaction here, this debit line. You'll also notice here, on February the 25th, we reduced our preferred share account when we bought back 4,000 preferred shares, and we also, when we bought back on April the 26th 5,000 preferred shares, we reduced it by 24,125. So these two numbers here, 19.3 and 24,125, are also in our requirement to help us calculate the ending balance in the preferred share account. So that will give us a final balance of 308,800. For your common shares, same thing. The question told us that your opening balance for common share equity, if you go back to the small equity section, was 642,000. But you will remember on, according to this, on February the 12th, here, let's go back up there, we noticed that we bought back some common shares from our investors and we removed them from our books based on the average issue price of $16,050. So we're removing $16,050 of common share equity, and we're also on July the 16th removing $64,200 in common share equity when we bought back our 8,000 shares at an average issue price of $8.02 a share. So therefore, if you factor that into your calculation of the ending balance of common share equity, you've got those two numbers in here. Don't forget that we also had issued common shares on July 30th of 27,125, which increased our common share equity. So notice we've got to go in there and pick that up and increase it. So if I increase my common share equity after deducting these two amounts, I'm going to have $588,875. Notice that I do not have an account for contributed capital on preferred share retirement. Why? It's a zero balance. You may remember, I'm just going to scroll up here, that we did have in our entries here a creation of a contributed capital on preferred share retirement account on February 25th. But we used it all up on April the 26th when we retired some preferred shares. So it's a zero balance. So that's why we've gone directly to calculating the balance and our contributed capital in the common share retirement account. Notice it started the beginning of January X5 at a balance of $14,000, but we reduced it by $59.50 on February the 12th when we removed, because of retirement, some common shares. You'll remember we debited common shares when we bought back 2,000 of our common shares at the average, or when we bought back 2,000 of our common shares, we removed them from our books at the average issue price, which is the average amount that that shareholders gave us for each share that they bought initially from us. So we're going to debit that $16,050. We paid out $22,000 cash to buy them back, so we have to reflect a debit because it cost us more to buy them back than shareholders gave us on average. And that led us to a debit of $59.50 on the common share retirement. So now if we go back down here, you'll notice that we've got the $59.50 in here. Now, how did we come up with the $4,200 common share retirement item down here? Well, don't forget, we see that we have a transaction that happened on July the 8th, or July the 16th, so let's go back up there. On July the 16th, when we bought back 8,000 common shares, we removed them from our books at the average price that we issued them initially to investors at, which was $8.02. So we debited that $64,200. But remember, it cost us less to buy them back than at $7.50 than we got initially, which is $8.02. So therefore, we're now creating contributed capital because we got a bargain. It cost us less to buy them back than the investors originally gave us when they originally bought them. So that $4,200 gets credited to contributed capital on common share retirement right over here. And so we have an ending balance of $12,250, which gives us total contributed capital of $909,925. Now let's see if we can calculate our retained earnings balance at the end of the year. Well, we started off in the equity section in our question at $1,250,000 in retained earnings, and you'll notice that the question tells us in the required section part 2, they tell us that earnings or income during the year was $308,200, and you know that income gets closed out to retained earnings, right? We also remember that during the period, we had to debit retained earnings a couple of times when we had share retirements. So when did we do that? Well, our little footnotes tell us we did it on January the 15th, and we also did it on April the 26th. So let's go back to those two entries and see what happened. Well, on January the 15th, that was our first transaction. You'll notice because we didn't have any contributed capital on preferred share retirement at that time to debit, okay, we had to charge it all up to retained earnings. You'll also remember, if you go down to the other entry here, when we made a retirement, where was it here? 2575, that was on April the 26th. Right? We also had to debit retained earnings here when we had another preferred share retirement. Why? Because we already drew down on contributed capital to the extent that we had it. We only had $3,300 in it. We had calculated that here. But now we didn't have enough to balance the entry, so we had to debit retained earnings by an additional $25.75. So what we did is we reduced retained earnings by that additional amount. You'll remember that we also had two dividend transactions. We had the share dividend that was declared, which was debited to the share dividend or stock dividend declared account, or which gets closed out to retained earnings, and the cash dividends, both of which get closed out, that were declared, both of which get closed out to retained earnings. So in total, these two amounts here would be added together in order to give us the total amount of cash dividends declared that get closed out to retained earnings. In our case, all we did was separate them up. So this $27,125 are the share dividends that were declared that got closed out to retained earnings, and these two amounts here were the cash dividends, the $44.8 for the preferreds and the $73.5 for the common, the dividends, the cash dividends that were declared. And that gives us in total $1,407,575 in retained earnings. But don't forget, we also had reserves, or AOCI, there. At the beginning, the balance was $38,000. But your question tells you that you had comprehensive income of $351,000. And that was divided up into two parts. Okay, maybe I'll just do a little thing here. You had comprehensive income, and that's based on net income plus any OCI that you recorded for the year. Well, they already told you that short comprehensive income was $351,000, right? And you know that, which is equal to $351,000. So what does that mean? That't that your net income, according to the question, was $308,200. And your OCI, and your OCI was equal to $42,800. They gave you that in the question. So you'll see here that these two numbers added together are your comprehensive income. Again, you may remember this from one of your prerequisite courses where we talked about the relationship between comprehensive income, net income, and any OCI recorded during the period. Well, they gave you that amount here. They told you that OCI was $42,800. So that foreign exchange gain caused by a foreign subsidiary is one of the types of things that creates OCI. And OCI, as we know, updates AOCI or reserves. So you had to add in that $42,800 to update your reserves account. So you're going to get $80,800. That's going to leave you with an ending balance of $2,398,300 as your total shareholders' equity at the end of X5. I hope you found the video helpful. Have a nice day.